Hello and welcome to this Real Deals webinar in association with IPEM, where we will assess the current environment and plot the roadmap to Covid-19 recovery. I'm Talia Masiri, editor at Real Deals, and today I'm joined by Antoine Coulson, CEO at IPEM, and our guest speaker, Nicholas Brooks, Head of Economic and Investment Research at ICG, who will be presenting. Nick is responsible for formulating ICG's top-down macro and market views. He has over 20 years of investment experience as a global economist and strategist, covering a wide range of markets, asset classes, and geographies. Prior to joining ICG, he spent over 7 years at ETF Securities as head of research and investment strategy, where he built and managed the institutional team. He has also held senior roles at Henderson Global Investors, Deutsche Bank, and Citibank. Before we pass on to Nicholas, I believe Antoine has a few words to say also. Hi, Antoine.
Hi, Talia. Thank you very much. This is indeed a pleasure to team up again today with Real Deals for this webinar. And I am particularly excited to hear Nick about the path to COVID-19 recovery. Those who were at IPEM last January may remember Nick's keynote presentation. While the title of the presentation was rather sobering, "Is Europe heading to a recession?" Nick's takes were rather positive at the time. He only, if I remember well, pointed out one tiny gray cloud in the horizon, the outbreak of a coronavirus in the province of Wuhan, China, about which we knew very little at the time. This was only 4 months ago, and it seems that it was a century. As many European countries are now progressively easing their lockdown policies and opening back their economies, we think it is important to have some macro views and scenarios. There is still much uncertainty about the virus itself and the prospects of an economic recovery. However, exploring different scenarios in the current situation is essential for all market participants. So we are really glad that Nick is sharing today his roadmap to recovery. Today, Nick will be discussing what are the impact of COVID-19 on the global economy, the government's responses so far, recovery scenarios and roadmaps, and the implications for country, sector, and company performance going forward. We do encourage questions, so please do send them through for the final part of the webinar. I will be sending the link shortly in the live chat session in this webinar. And we're also conducting a live poll during this session. The question is, which segment in private markets will emerge as the winner in the corona crisis? So please use the same link to cast your vote. But now, without further ado, over to you, Nick.
There we go. So I hope you're all seeing my slides with the title slide now, the COVID-19 Macro Impact Assessment Roadmap to Recovery. So the way I'd like to start the presentation is first just highlighting where we are today. And I think the crucial variables in determining when we get out of this and how we get out of this are, number one, our ability to control the COVID-19 contagion, clearly. Number two, the government response during the shutdown periods and the ability to effectively hold economies in suspended animation until growth can resume. And third, the expense and the impact of the expense of holding economies up for an extended period. This will determine the speed and trajectory of the medium-term recovery post-COVID. So focusing first on what I think is critically the most important determinant of how quickly and the trajectory that we get through this crisis, and that is tracking what's happening with daily new cases. Now, if you read the press here in Europe and to some degree in the US, you get a sense that COVID is coming under control, that things are getting back on track. But if you look at the chart I've got up on the screen now, you'll see that at a global level, that's not the case, unfortunately. Daily new cases, after stabilizing for a period in mid-April, have started to re-accelerate. Primarily, this is occurring in developing economies. So this is happening in India, in Mexico, in Russia, in Brazil. So far, we do not have a lot of data coming out of Africa, but it's pretty clear that at a global level, COVID-19 is not yet fully under control. And this matters very much, clearly, for global growth. And it matters also even for those countries that appear to have got COVID-19 under control, because to the degree that travel reopens, new cases will occur. So it really is a global problem, and until it's controlled at a global level, it's going to be with us. Looking at country and regional trends, there are some wide variations. So if we move to the next slide, you can see, looking at Europe, new cases have been falling very quickly, and in most countries, they're at or below around 1,000 a day. Some cases well below 1,000, some cases a little bit above. A laggard within Europe is the UK. So again, if you read the newspapers here in the UK, there's a lot of discussion about falling deaths and falling new cases. But what I think really matters is the speed and the trajectory of the decline. And while the UK was, I think the rule of thumb was around 2 weeks behind most of continental Europe, that's extended now to being maybe more than 4 weeks behind. So the effectiveness of the policies put in place in the UK have so far not been as effective as those in continental Europe. We see a similar problem in the US. Sorry, slide too far. If you look at US cases, so US new cases are slowing, and that's great. But a large part of the decline has been due to the sharp fall off in new daily cases in New York, which was, of course, the epicenter of the crisis in the US and globally for a period of time, almost a third of US cases back in April. Now, the very severe clampdown in New York has brought new daily cases back down to lower levels. But outside of New York, new case growth is still very high. I didn't want to put too many charts in this presentation, but I track on a state-by-state level, and you'll see that in Texas and Illinois, case growth is picking up. In California, it's still at a very high level. And the reason this is concerning is that to the degree that there are not restrictions on interstate travel in the US, and that's highly unlikely and would be very difficult to implement, there's a danger that the COVID cases ricochet around the US, prolonging the crisis there. I would argue that what's really needed is a federal policy that would allow for a more sort of concerted effort in bringing case growth under control. This matters a lot, not just for the US, but for the global economy, because of course the US is still the world's largest economy. And even in countries where new case growth is under control and reopening is taking place, if the US economy and recovery is lagging, that will affect other countries' growth rates. So moving to the next slide, in terms of growth, where do we stand? I think it's well known that economic growth has slowed very sharply over the past few months. On this chart, I'm showing the global purchasing manager indices, which are good high frequency indicators of economic growth. And if you look at the chart on the left side of this page, you'll see how the slowdown has been very much focused in the services sector. No surprise there, focusing very much on the consumer sectors. Manufacturing has also been hit, though to a lesser degree. And this data is till April, and it's pretty clear that this weakness is going to continue through the second quarter. And forecasts within the developed world are for quarter-on-quarter seasonally adjusted growth rates in the second quarter of anywhere from -10% to -30% growth. But of course, what investors and markets care about is where do we go from here? I think it's well recognized that the economies have been shut down and therefore growth will be very weak. Looking at the right side of this slide, you can see what's happening at a regional level. Europe hit particularly hard. US less so, but it's also lagged. I suspect the numbers in the US in the next month or two will start looking more like those in Europe. But what's important to highlight is that in China, which went into this crisis first and has come out first, we're seeing the composite PMI start to pick up. And the smaller chart in that bigger chart is looking at a breakdown of services and manufacturing. What I thought was interesting to note was that it's not just a rebound in manufacturing, but it's also been a rebound in services. So growth rates are still well below they were pre-COVID, but it does give some hope that once the COVID-19 growth has been brought under control, economies can start moving back and get back on their feet quite quickly. Looking again at high frequency data in some other countries, this is using Experian footfall data, retail footfall data. Now this will include food retail, so these statistics aren't perfect, but they give you a sense on a weekly basis what's happening in terms of retail activity. And again, it's interesting to note that in Austria, where new case growth was brought under control quite early and reopening has happened early, we've seen quite a big pickup in footfall on the retail side. In Hong Kong, it never dropped that much because they've kept new case growth under control through most of this crisis. And you can see that Germany is at the moment moving in the direction of Austria. Again, highlighting how quickly things can turn once COVID-19 contagion has been brought under control. So the other side of the equation is what governments are doing. And the government reaction has been utterly massive. So we have seen an increase in fiscal spending globally. The estimates are getting close to 10 trillion US dollars currently. That would be more than was spent through the whole 2008-9 crisis. So within a matter of months, we're seeing more funds committed than we saw through the whole 2008-9 crisis. As you can see in the chart here on slide 9, a large part of that in some countries has been loans and equity injections and guarantees, with direct fiscal measures, a bit lower than that. I think a key turning point, in my view, on the programs, because the initial phase of the programs had some serious implementation teething problems, where the funds that were released by the government were not getting to businesses. I think part of that issue was that it was getting stuck in the banking system because in many cases, the loans were not fully guaranteed. For example, in the UK, they were 80% guaranteed. However, in Germany, they moved to 100% guarantee for small business loans, so on the smaller end of the scale, and funds started to flow quite quickly. Same in Switzerland, and the UK moved in that direction as well, and funds started to flow. So these programs by no means are perfect, and there's still a lot that needs to be done, and probably spending, not even probably, almost certainly spending will have to increase over the coming months. But there is starting to be seen positive impact from these programs. On the monetary front, the spending has been equally, if not more, substantial. So in this chart, I'm just looking at the ECB and the Fed. It's really been the Fed that's been doing the most aggressive legwork so far this crisis. But again, the size of the funds committed are absolutely massive. We're looking in the first 3 months since the outbreak of the crisis, more new funds committed than again through the whole 2008-9 period. So huge government and central bank response. In other words, they are trying to offset the private sector during this period of shutdown. So where to from here? I think structurally, there are going to be some major changes following this crisis. And one of the most important, of course, will be the much higher government debt levels post-crisis. So the data in this slide is taken from the IMF Fiscal Monitor from 6th of April. So these numbers will have increased since then. But just on those numbers, which I would argue are quite conservative, we are looking at debt to GDP levels of anywhere from 10% in Germany, Netherlands, to up to 25% higher than they were before the crisis. Now that, I think, number one, will have implications for global growth. And number two, will also cause differentiation between countries in terms of their ability to move back to pre-COVID growth rates on a sustainable basis. In other words, those countries that have substantially increased their debt levels from already high levels, Italy as a prime example, are going to be faced with some severe challenges in sustaining growth post-crisis. So what might the shape of the recovery look like? Again, nobody knows. There are so many factors that will drive the outlook. One factor that I haven't mentioned yet that would be a complete game changer, of course, would be an early discovery of a vaccine that worked and the ability to produce it in substantial size. That would be a game changer. If that were to happen quickly, we could move back to normality that much faster. And we can discuss this more in the Q&A, the likelihood of that. Again, I'm not a medical professional, so I will be able to refer to what I have been reading, but that clearly would change things. But barring a very quick discovery and production of an effective vaccine, again, this is using IMF scenarios from their World Economic Outlook in April. Their base case at that time was the green line here, which would have implied that we'd be getting back to 2019 GDP levels in the advanced economies by the end of 2021, which, you know, I would argue is quite optimistic. And, you know, I think the IMF, when they come out and with their next report, they will be revising this down. They've said as much because the data has come in much harsher than expected over the past month or so. The other scenarios, and this scenario was really based on getting the COVID-19 under control by June, and then gradual recovery through the second half of next year, and no major secondary waves of infection, and, you know, back to normality by Q4 2021. I think that's pretty unrealistic unless, again, a vaccine comes through very quickly. The second scenario, which I think is perhaps most realistic in my view, that I would probably put this as my current base case, which would be getting real GDP back to 2019 levels by the end of 2022. That would imply, on their scenario, a longer outbreak in 2020, and then a relatively steady recovery through 2021. My own view would be that we will get second waves, but they will likely be much smaller than what we've seen so far in most countries. So it may not be quite as smooth as this chart would indicate, but that doesn't seem unrealistic to me. A third scenario, and the third and the fourth, one can sort of mix together, this is not an exact science clearly, is that one, it takes longer to control the outbreak, this initial outbreak. And on top of that, we get a second wave. Now, again, the IMF estimate was an outbreak in 2021. I think it may be more likely at the end of this year, early in the year during the winter months. That could potentially throw growth off much more because of not just because it would extend the period for recovery, but also secondary effects on the economy will likely become larger because governments and central banks right now are able to sustain economies, not perfectly, but they're doing a pretty good job, I would argue. But there's a limit. These estimates for the debt levels were based on COVID-19 in most countries coming under control by June. Those numbers will rise substantially and at some point become unsustainable if this extends much further. And at that point, governments will have to cut back on support. And at that point, companies will face bankruptcy. And there will be much more permanent damage to the employment markets. So, that is a worst case scenario. And on those scenarios, again, assuming ultimately a vaccine is found, recovery back to 2019 levels may not occur until end 2023 or even 2024. Now, what's interesting to note, because I've put on this chart for comparison purposes, the 2008-9 crisis. And it's clear this crisis is going to be far more severe in the short term with drops back down to Great Depression levels in terms of economic activity. But again, as long as a vaccine can be found or herd immunity is ultimately achieved through infection and recovery, then we should come out of this much faster than we did the 2008 crisis, which was effectively a financial and banking crisis, which led to an extended period of rebuilding of banks' balance sheets, which weighed on growth for an extended period. So I think, just to sum up this chart, and really a key part of this presentation, is that the shape of this recovery, I think, is likely to be a sharp V initially, and mathematically that is clear. And then with a more gradual recovery through 2021, 2022. And how quickly we move back to 2019 levels will depend very much on secondary waves of infection. In other words, countries' ability to control contagion and track and trace, and how quickly we get a vaccine. Now, I've been talking in very generic terms, and I think that's generally, how a lot of the dialogue on this crisis has gone. What type of recovery are we going to see, and sort of in a very generic way. But as I've been trying to make clear through this presentation, it's going to vary widely by country and also very much by sector. Some sectors are going to come through this not unscathed. I think most sectors, except very few, are going to be hurt by this, but the variation will be huge. So the chart I've got here on slide 14, I've taken from the UK's Office of National Statistics. They do a business impact survey, and the latest that was released was on the 7th of May. And they ask a lot of questions to ongoing businesses across the UK. And I thought this was quite interesting because one of the statistics, or one of the questions that's asked, is how confident are you, or how sure are you that you will have resources to survive this COVID outbreak? And I think what you see here in this chart, very clearly shows how countries how companies are being affected. So again, perhaps no surprise, arts, entertainment, and recreation, over 50% are not confident that they're going to survive this outbreak. Again, this was the survey was done in late April, so support programs were in place. Again, they were having teething problems, so maybe some of these firms are now getting access to financing they didn't have before. Then after that, accommodation and food service, administration and support services, transport, airlines, all, pretty unsure about their ability to survive this crisis. On the other end of the spectrum, though, you have information and telecoms. You've got some manufacturing, professional, scientific, and technical, and I would argue also clearly, food, retail, technology, where their perception of their ability to survive is much stronger. So I think when we're looking from an investor's point of view, I think we're very much in an environment where bottom-up analysis is absolutely critical. Just buying the index on a hope for a risk asset rally, or shorting on the other side, is going to be less effective, I think, in this environment, because it's going to vary widely by sector, by subsector, and even within subsectors. There are going to be a lot of differences between individual companies. Companies that came into the crisis with relatively strong balance sheets, that had access to external finance, revolvers, et cetera, can get through this. If they have to get through another 3-6 months with very limited activity, and they've got access to financing or good cash on the balance sheet, they'll be fine. And they'll come out of this potentially much stronger, because the weaker companies, those that went into this crisis with weak balance sheets, didn't have access to financing, if they don't survive, or they have to sell, or they have to give up parts of their businesses, those stronger companies will be in a position to consolidate. So I think this is really very much a bottom-up market, and analysis has to be done on that front. So of course, the top-down matters. How are new cases trending? What are the broad growth rates looking like? They matter. But ultimately, from an investment point of view, you really have to get down to the nitty-gritty of the companies. And my sense is that the variations that we're seeing now at a sector, subsector, and company level will sustain. I don't think it's just short term. I think on a medium term basis, as in over the next 12 to 24 months, I think those companies in safer sectors and with strong balance sheets are going to continue to outperform. So before moving on to the Q&A section, just to summarize some of the kind of key points, I think that recovery is likely to be quite gradual and uneven at a sector and country level. We're likely to see some second waves of contagion. We've seen that in Singapore, we've seen that in Korea, we're now seeing that in parts of China, we saw that in Japan. It seems quite clear that we will get that occurring in Europe, and that will occur at a state level in the US, and therefore potentially at an aggregate level in the US. So we're not out of this yet, by any means. We have seen opening in some countries. It's very tentative. My own view is that it's unlikely to be sustained. I think that we will probably see minor bumps up in new cases and forced close down again. Again, exactly what we've seen in Singapore more recently. Global GDP, I think, is unlikely to return to 2019 levels until end of 2022 at the earliest. Again, early availability of a vaccine in sizable amounts would be a game changer. And there are some indications that progress is being made on that front. So, cross fingers that that will occur. But I think one shouldn't be betting one's, putting one's portfolio on that. Post-crisis, we're likely to see tax increases in most countries and spending cuts as well, though given the state of the world and the sort of populist moves in many countries, I think spending cuts will be more difficult. So it may fall more on higher taxes, and that is going to reduce potential growth rates. So I think most economies, potential growth rates post this COVID crisis will be lower than pre-COVID, mainly because of the huge increases in government debt and the need for higher taxes. And that will affect consumer behavior, and that will also affect business investment behavior. So again, one can differentiate, going back to that chart, looking at the forecast for deficits. Germany, Netherlands don't look so bad. Italy, Spain, US don't. So there'll be differentiations. The inflation question, which I won't go into in depth now, if there's a question on this later, I'm very happy to do it. But my own view would be that certainly in the near and medium term that inflation is likely to remain low. We could see some minor spikes based on currency depreciations and imported inflation, or some temporary breakdowns in supply chains. But ultimately, I think, for the reasons I mentioned earlier, with slower potential growth rates, I think continued pressure, downward pressure on domestic demand, or weaker domestic demand, that ultimately this is more of a demand than a supply shock in the medium term, and therefore price levels will remain low. And then on top of that, although oil prices have come back more recently, they're still very low by historical standards, and with lower energy prices also keeping CPIs under control. So I think that is a more likely scenario, certainly in the near and medium term. That means central banks will be able to keep rates low, which they need to do given the size of government debt levels. So I think policy rates will remain very low. And I think that government yields, certainly for the core economies, will remain low. Obviously, what's happening in some of the peripheral countries is another story. But I think core yields will remain low. One positive on all of this, I think, though, is that if we end up even in a lower growth world, but we come through this, and we will come through this, and we move back to normality, interest rates are going to be low, I think. And I think central bank balance sheets are going to remain far larger. I don't think they're going to be reducing them anytime soon. And similar to what we saw after 2008, 2009, I think that's quite positive for asset prices. So we may not be seeing consumer price increases, but I suspect that we will be moving back into a asset price inflation world. May not be ideal in many ways from a structural point of view, but I suspect that will be another result of this crisis. And then lastly, as I highlighted, sector and country performance will likely diverge, and bottom-up analysis, I think, is going to be utterly crucial in terms of investment strategies going forward. So those were the main points I wanted to make, and I will now turn back to Antoine.
Thank you.
Thank you. Here, Nick. Really, really great presentation there, Nick. Thank you so much. Really kind of comprehensive and a lot to think about. Certainly the slide in which you showed the manufacturing and services decline during this period was definitely something that kind of stood out and can be quite kind of daunting on first glance. But I think it does bring us on nicely to a question that came in while you were speaking. And it's kind of on manufacturing. What would you say are the implications going to be in terms of, in regards to China? And specifically, could the crisis give that boost to manufacturing in the UK and Europe and away from relying on China as much?
Yeah, no, very good question. I think manufacturing is an interesting one. If you look at the China data, and if one believes the data, in China, it appears that manufacturing is nearly back up to 100%, 2019 levels. I think that manufacturing, it appears, is easier to get up and running. Well, particularly in China, where you have dormitories, you can do checks, and therefore people can get onto the assembly lines as normal. That may not be quite the same in the West, but I think, yes, it does appear that on the manufacturing side, it is certainly easier than in most services businesses to get back closer to normality faster. So that's a positive, and that's certainly a big positive. But I think there are two risks to manufacturing going forward. The first is China got back up to speed, but who are they going to sell to? So, they're doing a bit of catch up right now, having, shut down for a while. But once they've restocked inventory, who are they selling to? So it is a global world, no matter what people say about, deglobalization. I don't think we're going to be moving rapidly the other way, in very aggregate terms. And if the Chinese manufacturers don't have someone to sell to, they're going to have to slow production. And I think we'll find a similar situation, in Europe and in the US. It really depends. You need the consumer. Ultimately, you need the consumer to have a sustained pickup in manufacturing. So yes, we could see an initial pickup in growth, but then I think it will level out. And then just addressing the second part of the question on globalization, deglobalization. I mean, very quickly, it's obviously it's a hugely complicated area, but I mean, my own sense is we are in a global world, and supply chains after this, countries bring more home? Probably, in certain industries, particularly industries that are viewed as vital from a national security point of view and medical point of view now. But I think for most products, I mean, shoes, t-shirts, more complicated things than that, most businesses, or margins across most businesses, are pretty tight. I think are still going to go try to source the cheapest place they can get things made. So, I think there will be some breakdown and some bringing home of supply chains, but, as a proportion of total global trade, I suspect it will be quite small.
Sure. And just adding to that very quickly, Nick, another question came through kind of linking to that. So do you think people will have the same trust for the Chinese supply chain in the future, or is this also likely to be tarnished to some extent?
I mean, I think it depends on the industry, most likely. So I think for your standard products, the stuff that we're buying in shops on the high street, or today we're not, today we're buying online, and for the great bulk of products, I don't see why there would be a breakdown on that front. For security related or vital national security related industries, yes, I could see that. I think there's clearly, building distrust between certain countries and China. 5G is an example, but yeah, I think for your broad range of furniture, your basic, household goods, etc., I don't see that changing.
Sure. Okay, and I think Antoine has some questions from the Slido.
Yes, and Nick, thanks a lot for this clear and powerful analysis in such a complex situation. I'm really sure the audience enjoyed it too. There's a question on Slido, and I hope that everybody got the link to take part to this Q&A session. The question is, what are the exit strategies in a low growth and more leveraged than ever world? How do you see policymakers and the economy getting out of this situation, which is probably linked to another question that arose, tackling some comments that have been made recently about the rise of hyperinflation or debt monetization. So what's your takes on that, Nick?
Yeah, sorry, the last bit you said, the rise of what? I missed the last words.
Hyperinflation.
Oh, hyperinflation, right.
Yeah.
Yeah, I think that I think the exit, again, barring widespread availability of a vaccine, will be gradual. I think that it's very unlikely that central banks will be quickly unwinding the massive increases in their balance sheets, and I'm speaking specifically of the Fed and the ECB and the BOE. I think it will be gradual. I think on the fiscal side, they will probably try to reduce their programs as quickly as possible. We saw that in the UK, they wanted to initially reduce the furlough program because it's so expensive for the government. But now they've extended. I think they recognize they have to, but I think they will try to exit those as quickly as possible. So, I guess the way I look at it from a framework point of view is basically government is replacing private sector demand, and there's a limit to that. To the degree that my own base case would be that COVID-19 comes back, maybe not as severely as it has been recently, I think that the recovery in demand after that initial sort of mathematical sharp rise, possibly in the third and fourth quarter of this year, then levels out. And it's just a sort of a modest increase. And over that period, the government will be, and every country is different, but broadly will be reducing their support to the degree that private demand is coming back. Where mistakes will be made is when support is withdrawn too fast. And then you can get more permanent scarring. And when I say permanent scarring, it means, people lose their jobs and those jobs don't come back. So I think it's going to be ultimately after that initial burst of growth, quite a gradual recovery.
Interesting, yeah. Okay, yes. So I guess the rebalancing, as you mentioned, is really interesting there, and kind of as private markets come more into play, public and government assistance will kind of lessen. And then just a final question maybe before we move on, and Anton can take us through the results of the Slido poll. But what key indicators are you currently following to assess the recovery, and also kind of scenarios that you're putting forward here?
Yeah, I think that number one, as I kind of highlighted through the presentation, is really looking at new daily cases. I think it's not perfect by any means. The data is getting better, but you have to be quite careful with this data. But broadly, looking at the trend. So it's not the actual levels, but it's the trend. And understanding how quickly COVID-19's contagion is coming under control and staying under control critically. So I think that's number one. I think that really is by far the most important thing right now. Then I would argue that it is the very high frequency data. So for example, looking at footfall data on a weekly basis to get a sense for how quickly are people moving back. Google Analytics also provides data on how people are moving, based on apps, etc. So you can sort of see how people are moving and how quickly. I think it's too early to really focus on it too much right now, but it certainly is over the next 3 to 6 months. That's going to matter much more as COVID comes under control. And there's very little in terms of economic indicators you can look at on vaccine success, though one has to be on top of that. Again, very difficult in one statistic or one index to check, but I think also understanding the effectiveness of government support programs. And I find that the surveys that are being done at a country level are very useful. For example, the ONS survey of companies' attitudes on being able to survive the COVID crisis and getting an understanding of whether the financing is actually getting to these firms. So I think those are really the crucial variables. But the number one statistic in my view right now is really tracking the success rates on COVID control, and that is to do daily. cases, and related to that, as it ramps up, will be, track and trace.
Yeah.
Thanks, Nick, for these comments. What I suggest, I'm sorry, but we won't be able to answer all the questions that been asked, but some of them may refer to an in-depth focus to private markets, and I would like to turn to the actual poll that we conducted. So Nick, you probably have the answers on your screen right now. The question was, which segment in private markets will emerge as the winner in this crisis? And in a very short time, the special situations and distressed strategies make a terrific comeback in the poll. What are your ideas about these answers in this poll, Nick?
Let me just make sure I'm looking at this properly. Okay.
Can you see them?
Yes, I can see them. Yeah. So number one there is a special situation distress. Absolutely. Yes. I mean, I think that this is, of course, an environment where there are many companies that need financing, and I think increasingly so. There's always a bit of a lag. So I think over the next few months, it will become clearer, particularly as, some of these government programs, are slowed. I think that there will be a great need for capital, and that's what special situation distress funds are there for, is to provide capital in an environment where firms need it. So I think that there will be great opportunity in this front, and again, at some point we will find a vaccine, or we will get herd immunity one way or the other, I suspect, from COVID-19. We will go back to normal, or close to normal. And, clearly there will be a lot of very, very good companies that come out of this. And then the second one, tied with impact, is private credit. And clearly private credit is in a very good place here, in the sense that with very granular understanding of companies that private companies are involved with, private credit companies are involved with, are in a position to support companies through this crisis. And as I said, ultimately we will have recovery. It's just a matter of getting through this phase. So again, I think a very good opportunity for private credit companies that have a medium to longer term view on their portfolio companies. And then we go through the rest, and I think
it's still moving, like the situation.
Yeah, I see it's still moving. I
virus.
see it's still moving.
Yeah.
So I mean, those two really do stand out for me, but clearly there will be other areas that do well also. And again, going back to the analysis on the country level, the sector level, it will also be true within these different types of strategies. There are going to be some strategies that are better than others. So clearly, always a bottom-up approach is critical.
Thanks a lot, Nick, and thank you all of you for attending this webinar. I'm sorry not to take all the questions, but I'm sure, Nick, you'll have an even clearer view at IPEM 21 in early February next year, and it will be much clearer, and we'll be more able to comment the shape and insight of the recovery. So thanks a lot, Nick. This was a really powerful analysis of a very complex situation. One of the big challenges in the last few weeks was really to have a better understanding of the virus and its economic consequences, and to stay away from the drama. And I really believe that you helped us have a clear view about it today. So thanks a lot, Nick. Thanks, Talia. And hope to see you all together really soon. We'll be at IPEM.
Okay, thank you very much, Antoine. Very nice to be on.
Great, thank you all.
Thank you.